Bollinger Bands are useful in helping traders to identify the range that prices are trading within, as well as anticipate the volatility in the market. Given that it is an oscillator indicator, it works better in a ranging market where prices are trading sideways as compared to a trending market. Bollinger Bands are made up of 3 bands, known as the upper, lower, and middle band, as shown in the chart. Components of Bollinger Bands are: the length represents the period that the data is taken to plot the simple moving average, which is also the middle band. The upper and lower bands are formed by plotting 2 standard deviations away from the middle band. While using a standard deviation of 2 is the default setting, it can be changed according to the user's preference. Bollinger Bands can serve as a good indicator when trading in a ranging market. As shown in the chart below, when a price approaches the upper band, it serves as a dynamic resistance level where we could see prices reverse below this level. The upper band is also identified as an overbought region, which means the excessive buying pressure is pushing prices up higher. However, this is usually not sustainable in a ranging market, which is the reason we can expect prices to move lower after. Conversely, when prices are near the lower band, it serves as a dynamic support level where we could see prices bounce above this level. The lower band is also seen as an oversold region where excessive selling pressure is pushing prices lower. However, this is usually not sustainable in a ranging market, which is the reason why we can expect prices to move higher after. Now that we've covered the use of the upper and lower bands where approximately 90% of the price movement occurs, what about the other 10%? A strong break above or below the Bollinger Bands is usually triggered by high-impact news events. Examples include an announcement of new tariffs imposed by the US on other countries, or a sudden change in interest rates by central banks. In these scenarios, prices could push higher or lower, testing the extreme limits of the band. In fact, in the chart, we can see prices testing the upper band and showing no signs of pulling back. Another popular concept with Bollinger Bands is using the squeeze to anticipate the volatile movement in prices. As shown in the chart, the squeeze, as depicted by the blue arrows, is seen when the upper and lower band comes closer together, narrowing the gap between them. This is considered a period of low volatility as prices are trading within a smaller range, and it's useful in helping us to anticipate the volatility that follows. After seeing the squeeze, we can expect an increase in volatility where prices cover a wider range within a short period of time. Conversely, the further the upper and lower bands are from one another, we can expect a decrease in volatility following that. However, these are not trading signals, as they do not give an indication as to when the change might take place or the direction that prices could move. Hence, we would need to combine them with other indicators to generate more accurate trading signals. It is over for this section. Please like, subscribe, and turn on the notification bell so you're the first to know when the next video on average true range ATR is released.